Welcome to the Grow Your Money podcast, where we're on a mission to change how we talk about money. Our fireside chats are the heart of our show, bringing the energy and excitement of in-person events straight to your ears. We aim to connect you with inspiring voices and stories that matter, sharing relatable experiences and insights that will transform your financial life. Everyone deserves access to practical financial knowledge, so we're making money conversations relatable by inviting guests from all walks of life to share their real-life experiences with money. But this isn't your typical money show. We look at the emotional, psychological, and cultural factors that shape our relationship with money. So hit subscribe and join us for another episode of the Grow Your Money podcast.
Our mission is to overcome financial, cultural, social, different barriers, educational, digital, by unlocking intergenerational power. So within Moneymatic, we've got work with youth, but also their parents and older folks. So we aim to have that intergenerational growth together, connecting communities. And today we've got Stephen joining us to share his expertise a little bit with us. So very thankful to Stephen for joining us. Thank you. So before we start, a little bit of overview. At the beginning of the webinar, we're going to be talking about the basics of mortgages. Stephen is going to talk us through that. And then he's going to explain how the process of mortgage application is, well, the pre-application and then the application as well. And then the extra, not the extra, but other things that are also involved in the process of mortgage acquisition. And then at the end of that, we're going to have a good chunk of question and answering time. So if you can keep your questions until the end, just in case they are mentioned, and then your question is answered. But also feel free to type in the chat, because Paul and me are going to be looking at them. And if they are missed amongst the chat, we will come back to the questions that maybe repeat. So with this said, I leave you the floor to you, Stephen. I'm going to mute myself now.
Brilliant. Thanks very much and welcome everyone. Yeah, you are in for a treat. It goes without saying, I know that many of you on this platform are probably new to homeownership in the UK. That doesn't necessarily mean you are new to the UK, but just the process of getting your first property in the UK. Some of you are probably a seasoned homeowner. You know the process like the back of your hand. In any case, this webinar is going to benefit every single one of you, because we are in a different times when it comes to home ownership and different lending criteria. Everybody probably knows about what the interest rate is saying, but in between that, you have different lenders, different criterias, and basically just offering different propositions to meet all an individual. Now, what I'm about to take you through, it's not specific advice to any single individual on this platform right now. So I don't know you, I don't know your situation, hence I'm not giving you a direct advice on anything mortgage. So what I'm doing is I'm going to lay the foundation, basic fundamentals. Now, that doesn't mean it fits hook, line, and sinker with your situation, and it could equally do. But what I'm saying is I'm not providing a specific tailored advice to any individual. It's a generic advice, and I'm sure many of you will benefit from it. So now the basics of getting a mortgage in the UK. Before we even start the slide, let me paint a little, just to put that into perspective. So mortgage is, it's basically you are borrowing a loan, a significant amount of money. The word mortgage comes to be when you are borrowing to secure against a specific property in this sense. So it's a loan you are taking from the bank, and you are taking out that money for a mortgage to buy a property. So you borrow against the property. We have the word mortgage comes into play. Similar to maybe some other aspect of you borrowing that's not to do with the with property specific now. So this is the first landing page, just to walk you through the basic things. Remember, before you can ask anyone, before you can ask the financial institution in the UK, I think the same. Let me stay in my lane as per speaking into the UK financial system. You need to have a means of repaying that money. So this is where your income comes in. Before you ask for even £5,000, a car finance or whatever it might be, taking out a standalone loan, the lender, the financial institution, want to make sure you have a means of repaying that money, repaying that loan. So when it comes to mortgage, it's not any different in the sense that, okay, your income, we start from the income, the very first one. Okay, before you can put your hands up to borrow anything, to get a financial product, we want to see how you're going to make the repayment. As the slide disappeared from me, it's coming back. All right. So that is the first one. And your income is anything, your regular earnings. It could be your income, could anything, it's not just your salary, benefit falls under that category as well. If you receive some level of benefit, whatever that might be, all this will be classified, comes under income. It could be from work, it could be benefit, it could be for some other investment that you have. I'm going to dig a little bit deep into that later on. So basic work, investment, and benefit, all that comes under your income. Now, you have your income, then as part of the risk assessment of your ability to repay what you're about to secure, the loan you're about to secure, we have something that is called credit report. Now, this might be a new name to many of you. Some of you, it might be not new at all. No, it's not news to you. Now, credit report, this is your financial footprint. This is your financial scorecard, basically. It measures, it tracks how you are as an individual when it comes to financial product in the UK. So the lender, the banks, the building society knows nothing about you, but these are the people offering you different financial products, be it your car finance, be it your loan to do whatever you want, even including the likes of your utility, gas, electric, and all that. So these are the people that offer those loan, those financial products. The only way they get to know you is through your credit report. Now, and your credit report is a virtual report of your personal credit history, made up of place. We're going to come back to that, but let's go back to our four. Brilliant. Thank you very much. So this is what your credit report is. This is how the financial institution and the building society, this is how they get to know who you are. Now, talking about savings, this is your 4 box when it comes to getting ready, when it comes to thinking about mortgage. This is your 4 box that you have to make sure you keep an eye on at each every single time. Your income, your credit utilization and management, then savings, every little pennies, every little money you can put aside. You might not, it might be getting a mortgage might not be within your radar, but Money Metrics will tell you, as part of being financially savvy, you want to make sure you're always putting something aside. You don't want to you don't want money in, money out. You want to make sure you leave something for the raining day. In this case, you might leave more. It might goes beyond the raining days. It might be something for an investment, i.e. securing your own mortgage. Then one of the 4 boxes that you pre-qualification, if you like, when it comes to mortgage is, who are you in the UK? What standing do you have? Are you British citizen? What is your residency status in the UK? Are you over the age of 18? Which are some of the benchmark that, that applies to mortgage, domicile in the UK, working and earning under the right immigration status. For those that are not British citizen, you might fall under other different visa categories, EU settlement scheme, indefinite leave to remain, which is also known as ILR, leave to remain skilled worker, and all those visa category. So these are the pre-qualification, if you like, things that we want to make sure we know about you, things that you want to make sure you are doing well to get you steady. So let's move on to the next slide, please. Now, on this
Hello, I'm excited that you're here. My name is Tina Matembe, and I'm the founder of Moneymatics, a financial educator, as well as a financial inclusion expert. I'm so happy to present Thriving Beyond Borders to you. It's a personal finance guide showcasing the stories of migrants who moved to make the UK home, a conversation starter, an easy, thin read designed to be something that can help you pick up valuable tips and start your journey on how you can improve your own resources. I'm so excited to bring this to you. And it's been written as part of an Immigrants Financial Journey project, a wider project that was made possible by the Heritage Lottery Fund. So showcasing a bit of fun and storytelling, and then bringing out the top tips for money in a very small, compact read. I hope you enjoy it and join us on a journey of real people. Thank you for your time.
The next slide, brilliant. Types of income, I've actually captured a little bit of this, but just to put more flesh to it, money received, especially in a regular basis through work or investment, employment income. Now, so this is all part of pre-qualification now. If you come to me, I'm speaking into mortgage. How do you go about that? So I'm beginning to narrow down this meeting. I'm beginning to narrow down I'm beginning to give you more narrow down advice getting on the property ladder in the UK. The standard requirement when it comes to assessing your income for mortgage stands as you need to be at least 3 months in your current role. So if you have there are reasons for that. We need to make sure you are not the bank and building society. Remember, this is all to do with risk assessment. How are we sure that you're going to repay this loan? How are we sure that, as far as we can tell, you meet some certain criteria? One of them is minimum of 3 months pay slips is required in a full-time or part-time permanent employment. So permanent employment is the one that has no end date, basically, put it that way, okay? And by definition, we are employing you, Vivid Financial, you are an employee of Vivid Financial Solutions, for example. You are not on the contract. We are employing you are employed as a customer relationship administrator, for example, indefinitely. Your annual salary is 40,000 a year, for example, and after you have probational period of 3 months. So this is one of the reasons why the lenders, we generally ask for a 3-month pay slips, just to make sure you've passed the probational period. And yes, you are maintaining and you are continuing in that employment. Now, it could be, it's permanent employment. That could be full-time, it could be part-time, as long as it's a permanent employment. Now, some people do have second job or contract job, for example. So you are working full-time with Vivid Financial Solutions. We require your first 3 months pay slip as a benchmark. Some lender will consider some other measure depending on what industry you work in and many other aspects, but the standard is 3 months, just to give you that umbrella. Now, if you have another gig on the side, a second job, again, most lenders want to make sure your second job is sustainable, and one of the ways to determine that is we need to see you doing that second job for a minimum of 6 months. So, and whilst your permanent employment could require 3 months pay slips, it could be the lender could choose to ask for more than 3 months pay slips. But for your second job, minimum of 6 months pay slips is required. More pay slips, that's minimum. More pay slips could be required for your second job as well. So if you are in the contract role as well, again, depends on the different criteria. So not to flog you too much on the types of income, different criteria. If I stay on this, I'll be here for the next 3 hours. But the bottom line is we want to know that you have income coming in from any of this source. And based on the lender, they decide what we need to verify your income is sustainable and is consistent. So we'll move on to the next slide, please. So now I think I'm picking on credit report. Now, for those of you that might know very much about credit report, it is not about the I score on your credit report. It's good to have the I score. Let me read it word for word. Again, as mentioned earlier, is a factual report of your personal credit history. Now, and the second point there says companies use credit score to make decision on whether to offer you a mortgage, credit card, auto loan, and other credit product, as well as for tenant screening. For some of you that have been, I was once there. Everybody just wants to make sure, would you be able to fulfill this financial commit obligation? That is what it is. And like I said earlier, this is the only way this financial institution get to know you. It's not about out of 1,995 or something like that. You could be doing very well in maintaining your credit commitment, but is your what we call debt to ratio, have you maxed out your debt to ratio income, for example? And there is a debt to income ratio on an individual in the UK, what you earn versus what you can borrow. Have you maxed that out? In what I do, I see people that tells me they have a good credit score and they earn good money, but their debt, their outgoing ratio of the outgoing to what they actually earn doesn't leave anything left for them to use. Now we'll move on to the next part, please. So that is on savings and your credit report. So now talking about, so the first 4 boxes, your income, your credit report, savings, and your residency in the UK. Talking about planning, mortgage is not something you wake up in the morning and you say, I'm going to buy a property tomorrow. You want to work towards this. You want to plan for it. And when talking about financial planning, save as much as you can. For speaking directly to those that are probably new in the UK economy, please, you want to get grip on your finances as soon as possible, right? That doesn't necessarily speak into mortgage, only about everything, okay? You know what is coming in. You want to make sure you cut your coat according to your pocket, not your size, because you just want to make sure you keep leash on your credit commitment and your money spending. So one of the ways when it comes to planning for a mortgage, now many schemes out there, many good financial products out there that will help you. One of my favorite at the moment is a cash lifetime ISA. It's called Lisa, and it's offered by a number of financial institutions or some investment company as well. If you are planning on getting on the property ladder in the next 6 or 12 months, you are under the age of 40. Let me quickly make that clear. If you are looking to open a lifetime savings, cash lifetime savings account, this is only available to people under the age of 40. So as long as you are still as young as me in my 20s, you want to make sure you have a Lisa account. This will go a long way, especially towards purchasing your first home. And what is the benefit of that? Just exactly what it says in that. So it's an individual savings account that is designed to help people save for their first home or for retirement, but you have to be under the age of 40 when you open this account. That is because the government gives you 25% bonus on top of any money you save. So in every single year, you can save up to 4,000 each tax year. That is from the 3rd of April to the 30th of March next year. And for every single pound you save, you contribute, you get £1 back. So a lot of people, when they are explaining this to me in their own way, they tell me, save 4,000, get 5,000. And it's as simple as that when you do the mathematics. You can use the cash lifetime ISA to buy your first home, to buy your first house up to the value of 450,000. So there are some little regulations around it. You can open one if you are between age 18 and 36. So there are other means. If you are over the age of 40, You can also have what is called ISA, individual savings account. This one, you can save up to 20,000 on any single year, tax-free. So, and of course, it's tax-free, and of course, you get a little bit of interest on that based on who you take your product from. Moving on to the next slide, please. All right, before I move on, this webinar is to try to answer as many questions that you might have as possible. So just keep writing down the questions. We're going to have plenty of time for that. I'm not dwelling too much on some of the criteria because questions might come on. You might have questions around that later. So I'm flying through them, but still touching on the key part. We're going to have plenty of time for your question. All right, so mortgage types. Again, I could be on this one forever, okay? But it's good as part of this webinar to have an holistic approach and comprehensive view about the mortgage process for newcomers or refresher for seasoned homeowner. It's always a good one. So mortgage types and application process. Now, sit tight on this one, okay? It's a lot, but I'm going to make it simple. I'm going to simplify it as much as possible. All right, the first one, please. All right, okay. So you have types of mortgage, okay? Just so you understand this clear. Capital repayment is as simple as what it says. So giving you an example, if you take out a mortgage of 100,000 for over 20 years period, for example, so, and you keep that 100,000 in mind over 20 years, if you choose capital repayment, what you are saying or what you are doing in essence is by the end of the 20 years, you would have paid off both the capital, the 100,000, and any interest associated with the money you've borrowed. At the end of it, 100,000 or 200,000, for example, let's say the capital and the interest is going to be 200,000. Everything, all things being equal, you would have paid back 200,000 in 20 years. At the end of that year, at the end of the 20 years, you own nobody, nothing. The mortgage has been settled. The bank has been paid off. Building society paid off. You have your house now. It's all yours. That is what capital repayment is. You paid both the 100,000 you borrow and the interest that the lender, the bank, the building society charge on that. That is capital repayment. End of 20 years, nothing is left. Everything paid off. Interest only mortgage. Again, you bought a property of 100. You borrowed 100,000 to buy a property from the bank over 20 years, and you are doing interest only mortgage. Basically, in 20 years' time, there will still be 100,000 outstanding. Of course, nothing else, because you are servicing the interest year on year for the next 20 years. 100,000 that you borrow, which is the capital, will still be outstanding in 20 years. When you come for a mortgage like this, we want to have a conversation as to why, and also in 20 years' time, how are you going to repay that mortgage? That is where the repayment vehicle comes in. That is, again, another in-depth conversation. So part and part, this is the greedy one. So this is half repayment and half interest only. It's where you pay off some, but not the whole amount. So it combines both of the capital repayment and the interest only. Those are your standard basic types of mortgage product. We move on to the next one, please. So now this is where we talk about the mortgage product. So again, if you are new to mortgage, to the homeownership in the UK, so you keep your mind on that 100,000. And let's say I'm going to stay with the capital repayment. You are buying your residential home, property for you and your family. You are borrowing 100,000 from the bank, and you want to pay it off over 20 years. Now, within that 20 years, you have options, okay? You might want to say, because of, when you talk to me, okay, 20 years is the term. You are taking the mortgage today, 100,000 over 20 years. Let's talk about what is your risk appetite. Do you want to know what you pay every month? Do you want to pay month on month based on what the variable rate is? If it goes down, you pay more. If it goes down, you pay less. If it goes up, so you have the fixed rate, which allows you to know what you pay month in, month out. for a set period of time. Okay, that could be 2 years, 1 year, 2 year, 3 year, 5 years, 10 years. You are locking in your repayment for that period. That's why it is called fixed period, fixed rate mortgage. Now, with that type of mortgage, that's why it's called. I won't complicate that for you. Standard variable rate is basically you are tracking with what the bank standard variable rate is. You are not tied into any. You still want to pay your mortgage off over the next 20 years. But what you pay month, you don't mind your interest rate. The variable rate goes up, you pay more, goes down, you pay. You are not tied to any specific deal from the bank or building society. Tracker rate for a set period. So for a set period, again, you are tracking the fixed rate, cap, discount, offset, and tracker. These ones are all these products aside of the standard variable rate are all for a period of time. So the bank are offering you a product to say, right, what about you track the interest rate? What about you pay just about your risk appetite? If the interest rate goes down, would you like to pay less? Yes. If it goes up, would you like to pay more? Maybe yes. If the yes is the answer, we find a product that suits that risk appetite of yours. All these products are for a set period of time. Again, 1, 2, 3, 5, or 10-year period. In that 20 years of repaying your mortgage, you have options of all or some of this in that period, all subject to your risk appetite and your family composition. A lot of conversation, when it comes to picking a mortgage product, as part of educating my customer as to the property you are looking for, we really want to make sure all this should be tailored. All this should be tailored, and the decision on what product, what type of mortgage product you go for is all dependent on, is largely determined by what you want. How does this property meet your need and the needs of your family presently? A lot of factor comes into play. Are you just a young couple with no children right now, and you are looking to buy the property you are looking to buy? How would that property still be suitable for your child? Well, assuming you are planning to have kids, and you've told me that. So then how is that going to fit into your family life later on? So all that conversation we need to have. So that is some of your mortgage product. We move on to the next slide, please. Okay, now step by step. All right, so you might want to write down step by step into our mortgage process. We've covered some basic fundamentals. Now, step by step, your pre-application. I split this into two. Mortgage affordability. In the nutshell, is simply a test run by a lender as part of your application. So when you come to me, I mentioned earlier, what is your income? How much are you earning? And what are the debts you have? What are your commitments? And your commitment, part of them is your council tax liability, your utility, your credit card, any loan, your car finance, anything you have, any product, any financial product you have. All this we just run to see how much you can potentially borrow. That is what the mortgage affordability is all about. And then look at all your financial. This is where your credit utilization comes in. How have you been managing these things well? To the second bullet point, on a residential mortgage, generally, the mortgage affordability rule of thumb is that most lenders will be willing to lend between 4.5 to 5.5. Now, to put that in a simple layman term, if you earn 25,000 a year, for example, your gross earning before tax. This is not what goes into your bank account. This is what you earn before tax, and all the NI and all that is deducted. The lender will multiply that by 4.5, minimum 4.49 to 5.5, depends, subject to INR, and different criteria goes into that. Don't ask me why is it 4.5 to 5.5, because I'll be here for the next 3 hours. So if you earn 25,000 a year and you multiply that by 4.5, what does that give you? I leave the answer to you. So that is the maximum you can potentially borrow before we before the lender start factoring in your commitments, your loan, your car finance, your financial commitment, which includes anyone, children or adults that are dependent on you for financial support. So all these will now give us a realistic view of what you could afford. Now we've done all that, we've had the conversation. This is what you can afford. This is potentially what you can borrow. Remember, telling you that you can borrow 100,000 doesn't mean you should borrow 100,000. You might not be interested in buying a property up to that because the bank is just doing assessment. The building society, the lender, just conducting an assessment to establish potentially what you can borrow. Now you can go low. There is nothing wrong in that. So decision in principle is the point where we now you now have a certificate. This is just a certificate. We've run the right system with the right lender that I think is okay, will be good for you, and then confirming your 100,000. Yes, potentially, all things being equal, subject to final mortgage application and underwriting. So this is just a promissory note at this point. We could potentially borrow you 100,000 subject to all of that criteria. Now, what follows after that now is you look for your own home. Again, I dwell on this as with every other aspect with a lot of my customer. You need to establish your non-negotiables, especially a bulk of my work is with the first-time buyers and know what it could be like. This property is good, or you wake up the following morning, another one is in the market, better than the one you saw yesterday or the one you are interested in. First and first is establish your non-negotiables, starting from your location. What are the things important to you? Close to work, close to transport network, close to shops, close to the city center, many of those things. So establish all that. We move on to the next one, please, which is the application stage. So application stage. Now, we check your affordability. We know how much you can borrow. You will have gotten your decision in principle. Now you found the property of your interest. Now we go on to the mortgage application. It is exactly what it is. In all that process of pre-application, getting all your documentation, every documentation that your broker, i.e. myself, I've used, all the verified documents I've used in my assessment of your mortgage suitability and affordability. I will now be packaging that alongside your property, the property of your choice, with the lender. Okay. And once that is done, the lender will review the document, assess the property. And also, this process is called underwriting, basically. This is where the lender, the bank now takes out their microscope and start tuning everything about your finance. So this is a deep dive process, basically. I want to make sure the property is okay, not just about you. Remember, the building society and the bank, they are also investing. This is why you have to pay interest on the mortgage, okay? They are also borrowing. So they want to make sure the risk is minimal, if at all, before they can go ahead with it. So all things being equal, underwriting process, property is fine. The lender makes you a mortgage offer, which is now saying, yes, we are happy with your credit profiling. We're happy with your salary. We verify all this document and as well as the property, and we are happy to release this money against that specific property. And then what happens after that? You just wait until your completion date, which is another stage. So for me, one of the things I do, once we have an offer from the lender, I make sure that I speak to my client and make sure that they have insurance in place. If they do not have one in place before this stage, let's make sure we have the right mortgage protection insurance in place. I'm not going to dwell on that, but the reason I do that, we've had, it's been fed back to us by, we've seen it in this job, whereby between receiving a mortgage offer and completion, life events, death or critical illness, things that were unforeseen had happened. A specific case by one of the insurance providers, there were this couple secured a mortgage offer, and they are not due to move into their new home by the end of April, for example. But between now and the end of April, one of the couple was diagnosed with cancer. So you can imagine how serious that case is, even though at that point in time, they've not really moved into the property because they've taken out insurance before they even start living in the property. Insurance was able to actually pay for the property. Of course, it was a sad event being diagnosed with cancer before you move to your own home, but insurance is in place to make sure. You can imagine if there was no insurance in place and you have to contemplate cancer and moving to your new home, priority change right away. Probably that would have been the end of their new home ownership because, well, there will be no income coming in from both of them. And one of them might end up being a carer to the other party. So that is why I speak about insurance, and I do that from the very beginning as well. It's a conversation that needs to be heard. So home insurance protects your home. 2 insurances I always recommend. One is mandatory, the other one is important. So home insurance, I'm not going to dwell on that, but those are the things you need to prepare for as part of the application process. Completion, which is the last point there. This is the date when you can move into your new home, the date you collect the key. And then the house belongs to, you officially own the property. So a lot of information to take in, but just remember the process, the first stage is plan for it. You cannot wake up one morning and say, I'm getting a property tomorrow. Plan for it. That is the first stage. And what are the things that will help you? Your income, your credit profiling, your savings, and of course, what is your residency criteria, status in the UK. All these are key in knowing that which lender you should go for. Again, as a broker, that is what I do to understand you and to be able to provide you a guideline. The second aspect is now, what the pre-application stage, affordability, assessment, decision in principle, and finding your own home. An application process, again, is capturing what to expect, submitting your verified document and the property details to the lender for them to do their own assessment. You have a mortgage offer, have your insurance in place, and you complete. And this last other key matters is a lot, and I don't want to break them down into different sessions so that we can have more time for your question. We'll move on, please. The first one. So now you have three musketeers when it comes to your mortgage. When you are at the application stage, basically before you even get to the application stage, the moment you say to me, right, Stephen, I found a property within what I can borrow and I'm going for it. The next thing at that point is, so you at the middle. We are all these people now. I work for you, and you also need the lawyer that handles the legal side of things. So this is where the conveyancing comes in, the name conveyancing. So it is the legal process involved when ownership of the property is transferred from a seller to the buyer. It could be a new built property. So everything to do with that property is being transferred to you. So you need a solicitor in place that will handle all this, making the offer on your behalf, and handling the legal paperwork of ownership, transferring the ownership to you. Then you also have, apologies. So moving costs. So you have the conveyancing, the solicitor practice, moving costs. Again, you can't just, you have to plan for moving to your new home. You have to plan for everything to do with if you need to get box. So part of your moving cost is, are you going to hire a van? Are you going to, whatever logistics you need to have in place to make sure that your home, your moving into your new home is as smooth as possible. This goes for everybody, even those that have bought properties, that have moved on multiple times. This is not necessarily for those that are buying for the first time. Everybody, it takes forever to pack, it takes forever to unpack. Plan for it, okay? This will ensure you are not out of pocket when it comes to, oh, we need to hire a van, it's going to take 2 days. And part of planning for this process is giving the right notification to your utility company, to your current landlord, and doing all those things and planning it accordingly. If you work with a good broker that understands this process, they will be able to advise you ahead of time They're not going to do most of these things for you, but give you the right comprehensive advice. Now, one of the I'm just going to read this out because you have the whole of UK, but you have different when it comes to land the stamp duty. You have UK, you have England, and you have Scotland, for example. So in Scotland, when you buy a property above 145,000, there will be a land and building transaction tax due on that. It's due on your 145. If you buy any property, there is land and building transaction tax to be paid. But if you are a first-time buyer, you get discount. You get discount, and that discount is dependent on what you buy, basically. But your first 145,000 in Scotland will be discounted. In England, is your first 250. This only applies to the first-time buyers. If you are selling to buy another one, well, that wouldn't apply to you, but look into that. So that is the summary of that too. Land and building transaction tax and stamp duty land tax. We'll move on to the, I think we're nearly there, if not the final one. All right, so other key matters, home insurance, I've covered that earlier. Mortgage insurance, again, this is the one that once you have an offer, I strongly advise that you have set up for life reasons. Life insurance trust, again, just giving a little nugget here. When you set up life insurance, critical illness, all these two key insurance policies, whole of life, make sure that they are written into trust. And also, please make sure you have a will, okay? These are all different topics and different subjects, but part of the holistic view, as part of these are the conversation I'm going to have with you when you come for a mortgage advice with me.
Thank you for listening to the Grow Your Money podcast. If you're looking to take actionable steps toward achieving your financial goals, visit moneymatix.com. That is moneymatix.com. And join our free Grow Your Money Challenge. Let's unite in the movement to inspire people to talk about money. Thank you for being a part of our community. We'll see you in the next episode.